Hello guys, welcome to today's sharpening session. It's been a while, I haven't done a sharpening session in a little while, so nice to be back to be doing sharpening with you. Now, let me just put the disclaimers up here on the screen. It says, there you go, just for you to read. Please do read them. It's always good to understand what you can expect from these kind of videos and what they're meant to be for. Now, saying that just to introduce the sharpening session, because it has been a while since the last one, and this may be the first one that you've ever done with me. We do these sharpening sessions over the weekend because we don't use these sessions to actually trade in. If you join us on our stock sessions, our future sessions, our FOREX sessions, we're placing trades. We're analysing the markets in real time and we're placing trades. In our sharpening sessions, these are more for theory and concepts and answering questions so that you understand more the rationale behind some of the things that we do rather than watching us do it that might be confusing in the moment. So for those of you that join live, if you are here with me, by all means ask me any question you want. I'm happy to go off what my sort of chosen topic of the day is in order to help you guys, in order to explain things that you need explaining. Of course, if you're watching recorded, then you can't interrupt me live, but by all means contact me and let me know what you'd like me to cover in future. I'm happy to be led by you. So in order to contact me, you have my email address here, which is becky@tradewithufos.com. You also have support@tradewithufos.com. So those are different email addresses that you can contact us on and let us know what your questions are. There's also this link here, which is tradewithufos.com/Becky. That will bring you to this page. Now, from this page, you can get different apps and platforms from the top here. If you scroll down, you can book one-on-one coaching if you'd like. And if you scroll down even further, there's a basically frequently asked questions section where you'll find lots of other people have asked questions and have had their questions answered. So you might find the question you have already has an answer here for you, or you can log in for free and post the question there yourself. And again, we'll answer it in this public space so other people can learn from it. So different places you can go for support and resources. We're here to help in whatever way that we can. Now, coming back to, let's take that off the screen, coming back to our sharpening session for the day, what I had planned to do was essentially describe, I guess the way to summarize it is risk tolerance and therefore actions that you might do depending on where you're at on that spectrum. Our job is, the way I see this anyway, our job as trading coaches is not to tell you, you must do this in exactly this way, or else you're wrong, or else you'll lose money. We can say, based on our experience, we would advise this or suggest this or this. Most of the time, my suggestion to people is, great, that's a great thought. Whatever it is that you're thinking, whatever theory that you have, test it and prove it, and then crack on. If you don't test it and prove it, then you're working off of a theory, and then you're putting your money where your mouth is for that theory, and that could end up biting you. However sound the theory, however pure the logic, it could still backfire on you in the markets if you're not testing it properly. So my job is not to say don't do that or do that. My job is to say find that out and help you, to guide you for you to then go and get the answers that you need for yourself, whilst also understanding we all have different needs on a spectrum. That could be a risk tolerance spectrum, which we'll talk about today, or that could be on a greed spectrum, that could be on the time availability spectrum, it could be on the capital available spectrum. Loads of different things that define us as traders, as individuals, and therefore change our action. So again, our job is not to say you will always risk X amount of dollars per trade on trades that happen at this time of the day in these markets. That's not our job. Our job is to say, this is how we see the markets. This is how you can apply methodology to all of those different types of spectrum. It's up to you to take it or not. It's up to you to layer things in or take things out as you choose. We are guiding you in what we believe works in the markets, understanding that you're going to apply it in different ways depending on where you fit. So coming back to sharpening, and what my job is to do today and in these sessions is to enhance that understanding for you so that you know where you might make those little concessions, where you might make those changes. The most important thing is that if you're making changes to a set methodology, which is fine, two things. Number one, test it, prove the point, don't just do it. And secondly, it's consistency. Don't change the action sometimes, but do other things other times, unless you have set rules as to why and how that's going to happen. And those set rules need to be on, as much as we can, objective things, not how I feel that day, not my interpretation of something. It's got to be set, mathematical, numerical, statistical, yes or no, black or white questions that you ask yourself before you might behave differently in one situation or another. So I'm overall right now just talking theory. So what I'm going to do, I'm going to bring up a chart and I'm just going to talk through different options you have in terms of more risk appetite or lower risk appetite. Now, usually, in fact, let's have a bit of a white space here for now. Okay. There we go. Brilliant. So nice white space on the side there so I can type on it and hopefully make the point. So risk tolerance, which is neither good or bad, it just is. You just need to know how to operate within your risk tolerance. Risk tolerance is usually, I think we'll do it like that, or maybe like that, not equal to, but usually associated also with greed for reward. Shall we call it that? The more you want to make and the more excited you are about that, usually the more risk you are willing to take. If you are very risk averse, then you accept you're not going to make as much. So they are in parallel. Now, that's not to say, by the way, take the greatest risk and therefore make the greatest return. That's not true. You might take the greatest risk and lose everything. Equally, it doesn't say, well, take barely no risk and you'll be fine, because you might take barely no risk and still lose, and you might take barely no risk and not really make anything. So these two are linked in terms of the way we think about it and what we're trying to do, but they're not necessarily linked in terms of the results at the end of the day. You could be managing your risk quite tightly but still make great rewards. It might just take you a long time to figure out the strategy to do that. You might be taking big risks all the time and not making very much. Like I said, it doesn't necessarily work that way in real life, but they're linked to each other in terms of our psychology around it. So that's the first thing to bear in mind. Now, risk tolerance, you could also think about this as, so let's write this down again. So risk tolerance could also be linked to our appetite for being right or wrong. So that kind of comes back into, we'll put this word in here, maybe use a different color to kind of make the point. This comes into probability. So there are three elements when we're trading that we need to balance. So we have risk, we have reward, and then we have probability. Now, what a lot of people think is that risk and probability might almost be the same thing, in the sense of the lower the probability that something happens, the more risky it is to do it. But really what they mean is that it's just less likely to happen. But you could still risk $1. So your risk isn't huge just because probability is low. Your risk, if your risk was $100,000 and that was all of your account on something that had a 10% chance of happening, that would be an extremely risky thing to do. But if you were risking $10 and that was 0.1% of your account on something that had a 10% probability of happening, it's not risky, it's just low probability. Now, nearly always, we want to make sure that we get a risk to reward ratio. So these two things, more often than not, kind of work together, but ideally we want to be risking the minimum to make the maximum within a reasonable range. What I mean by that is you could choose to risk $1 on a trade and put your target at 100 to 1. You could do that. You've got 100 to 1 reward to risk probability. Or, sorry, 100 to 1 reward to risk ratio. You've got that. But what is the probability of that happening? What's the likelihood of that trade moving 100 times away from where you bought it or where you sold it? Very, very low, very low. So kind of no point doing it. So we have to balance these three things in order to be profitable. But what I want to make clear is that there is a spectrum of profitability that still exists with these, regardless of what they are. So let me give you a kind of breakdown here. So we've got profitability. Let's do that in a different color just to make it different. Profitability. There we go. Okay. So reward plus risk plus probability equals profitability. But these aren't a set, it's not a set thing. Risk 1 to make 2 40% of the time, and that's the only way you can be profitable. We could work this out in many different ways to prove that you can have many different numbers within certain ranges here that work for you. Your job is to figure out which are the ones that make you more comfortable and therefore you're going to actually act on in a consistent way. So I'll tell you what I'll do. Let's bring up an Excel spreadsheet. She says, oh, it's opening on my other screen. So once it's opened, I'll bring it in. There we go. Okay, let's open up an Excel spreadsheet. Okay. So let's do this very quickly, and apologies I don't have anything actually ready to go here. I just thought in the moment it might make sense to do this mathematically. And what we'll look at is we will look at probability, risk and reward, and we'll put in different numbers in order to prove the point. So let's zoom this right in. Now let's have profitability first, or sorry, probability first, risk and reward. And again, let's make these maybe different colors to be very, very clear. And again, let's make it even bigger. And then let's do profitability here. Let's make that blue, just a different color. Okay, so what we also need to put in here, and we'll do this in a different color, is obviously the amount of trades that you place, but we'll get to that in a minute as to how that influences the rest of these things. So let's do a separate thing there. So if you have 10 trades, and I'm doing that just because it's a nice round number, 10 trades, let's put a probability rate in of 30%. Therefore, that many trades actually win. So 3 out of 10 trades would win. Let's say your risk, in every case, you are risking $10, okay, making that up. And you risk $10 in order to make 25. So you've got a 2.5 to 1 reward to risk ratio. And in fact, let's put that in there so we can see it. That divided by that, I believe, 2.5, lovely. Okay, so this is also less important. So these three equal this, but of course there's things that go around. So in this case, let's just do the maths on it. So 3 win, let's just put that there, profit. So this is going to be equal to that minus that. And these are the ones that lose. Cool. Let's put win and lose rather than profit and loss. Win and lose. Now, this means, let's do this. So each time we win, we make 25. Each time we lose, so that times that, we lose 10. So the profitability overall is that plus that. Okay, we've now put in our maths there so that we can kind of see what we're doing. So just to explain, because I know we all use Excel spreadsheets in different ways, and I have just written this in real quick. What we've got is we've got the amount of trades that we place up here. We've put our probability rate in. meaning the amount of times that we're right. Out of 100, how many times are we profitable? What's our percentage probability that we are right on a trade? How much we risk when we are trading, therefore how much we're willing to lose. How much do we make when we're right? And therefore, what's our profitability? How much do we make? How much do we lose? So in this example, let's say you are placing 10 trades a week. Okay, so a couple of trades a day, 10 trades a week. If you placed 10 trades a week and you risked $10 to make 25 bucks every time, that was your set reward to risk ratio, and you were only right 30% of the time, each week you would make $5. Now, I don't know, maybe your account is $100 and therefore you're making 5% a week. That's not bad. Maybe your account is $10,000, in which case you're making a very, very low percentage and maybe you don't think that's worth it. It's obviously all going to depend on your risk tolerance, how much you risk. So let's bring a slightly different dimension in here. So let's have account size and then also risk percentage. So bringing in these new concepts here, which are all to do with risk tolerance and balancing these numbers. So I'm making up the numbers. All of these numbers are made up just to give you examples and show you how the maths work. You can then go and play with these numbers and make your own spreadsheet as you see fit. So let's say we have an account size of $5,000 and risk percentage is 1%. Okay. What that means, we're going to say we will be risking, that's minus, risking 1% of our account each time. And our reward is, if we put this in 2.5 and we'll do it that way around. So our reward is always equal to that times that. Great, okay. So then we can play about with this number and see what the difference is. So let's say you had a $5,000 account. For each trade, you risk 1% of it. So you're risking $50 per trade in order to make 2.5 times that. So in this case now it's $125. Therefore, every week, assuming you're placing 10 trades a week, you're making 25 bucks, which as a percentage of your account is 1% of your account. In fact, it's less than that. It's 0.5% of your account. Now, are you happy making 0.5% of your account each week? Compounded in a year, that's not a bad return yearly compared to if anybody else were to trade your money for you, and in terms of if you were to give it to a fund manager most of the time. So you might be happy with that, but you might be saying 0.5% a week, it's not great. What do I do about it? You've got a few different options here. You can increase what you make per trade. In doing that, you will invariably reduce your probability. You could increase your risk appetite and risk a higher percentage of your trade each time, or higher percentage of your account each time. You could put more money in your account. You could place more trades. You could do all of those things. But each of those implies an impact on where you are on the spectrum of risk tolerance and other things. Money, time, the way you think about the markets. So let's take this one step at a time. Let's say you don't have any more money to put in the account. That's what you've got. Okay, could you increase? So let's say instead of risking 1% per trade, you risk 2% per trade. Well, now the exact same amount of trades, the exact same methodology, the exact same probability risk to reward ratio is now giving you 1% a week instead of 0.5% a week. Maybe you're much happier with the reward. 1% a week, assuming that you take that out of the account and don't let it compound, assuming you have a couple of weeks off in the year where you're not trading, it's 50% in a year. It's not a bad return at all. But again, you might be saying, I'm not happy with that because I need this to be an income. So if I'm making 50% a year off of $5,000, great percentage, but it's not replacing my income, or it's not paying the bills. Or it might, whatever. So different things that could be going on here. Could you increase that number again and risk more? Well, let's look. You risk 5% per trade. Now you're making 2.5% a week. Same amount of trades, same probability, same reward to risk ratio, but a very different profitability at the end. But this is where it's not as simple as the maths show. This is where we have to bring in our subjectivity, coming back to what I was saying at the start, where we need to be able to mold parts of a methodology or mold parts of an application depending on where we are on these spectrums. So risking 5% of your account per trade means each time you're trading, you're risking $250. You've only got a 30% probability of being right, which means 7 out of 10 trades are going to lose on average, worked out over time. You might have, in some cases, it might be 8, 9, 10 trades in a row lose, and then maybe you win 5 times. And then maybe you win once and then you lose 5 times and then you win twice. Whatever, but averagely over the course of many trades, you've got a 30% probability rate. So more or less, most of the time, about 7 out of 10 trades are going to lose. How do you feel in a 10 trade run if the first 7 are the losers and you've lost $250 each time? Does that affect you? $250, let's bring up a calculator here because I'm not very good at mental maths. $250 times 7, you've lost $1,750 so far that week. Maybe this is Thursday afternoon. And you've lost $1,750 out of your $5,000. That's a big chunk to lose. How do you feel about that? Are you comfortable with that? Are you going to be completely in the right zone to place the trade in the right way for the next trade that comes along? Or is it going to affect you? I don't know about you, that would affect me. As a percentage of that account, that would affect me a lot. If you're a robot that has no feelings or no thought process or anything, and you simply enact what the maths tell you, of course you place the next trade. And of course, each week on average, it's going to more than balance out to a profit at the end of the day, at the end of the week, end of the year. But emotionally, can you do that? Psychologically, can you do that? Is it going to impact your thought process? I would argue for most people, yes. For most people, yes. Now come back to the 1%. If you're risking $50 a trade, and you've got 30% probability rate, you're risking $50 a trade, and let's say the first 7 of the 10 trades that you're going to place that week lose. Well, in this case, you've lost $350. That might still affect you. If it does still affect you, lower that risk percentage even more. Because if it's affecting you emotionally or psychologically, or is affecting how you are now thinking about what you're going to do next in your trading, then you shouldn't be doing it. Because what that will stop you from doing is acting rationally, acting mechanically, acting like a robot. We want to try and act like robots as much as we can when we trade. Now we bring in subjectivity in terms of which of these mechanical elements do I need to do in certain ways in order to match my personality and my subjective life. Great. That's where subjectivity has its place in trading and should be. But on the actual enacting of the trades themselves and following a methodology, a checklist of what you're going to be doing, that needs to be as objective as possible. Not, I think this, I believe this, I read this, I interpreted that, but statistically, what's working? That needs to be our objective approach to our methodology. And you can mold the mechanics within that to your subjective profile, but you don't want to be subjective in your application of your trading, because that's when we lack consistency. If we lack consistency in our action, then we definitely lack consistency in our result. So we have these trades that are losing $350 before they then make 3 times 125, $375. So we lose $350, then we make $375. We're up $25 in the week. Now we might not be up by a lot, we might not be very happy with the percentage return. But if the risk is just about what we're comfortable with, we shouldn't be playing with that, because it's less likely to do anything for us. It's more likely to negatively impact our trade. So what else can we do? By the way, I should just say here, we recommend personally, at Tradictive, at Trade with UFOs, we would recommend no greater than a 2% risk. And the 2% risk should be for people that are extremely risk tolerant, for people that have experience and know what they're doing, and for people that perhaps have the account size to warrant that. So it shouldn't be that we're risking a lot per trade. Unfortunately, what happens, and I understand why, I get it, I'm a human, people that have smaller accounts, let's say it's a $100 account, because what they make, so that's 50 cents a week you would make with all of the same parameters exactly the same, versus the person that's got a $5,000 account that's making $25 a week. The person with a $100 account is making 50 cents a week. It's the exact same percentage return. Your performance is exactly the same in terms of relativity and in terms of the percentages, but it's worth a lot less money. So what people with smaller accounts do is they go, right, I'll risk 50% of my account then. You've only got to be wrong twice and you've lost your entire account. You can't be trading anymore. You might be lucky a couple of times and turn that $100 into $200 within a week, because you only had to be right a handful of times in order for that to happen. You then prove to yourself that you know what you're doing. Maybe you then go, right, I'll risk 60% or 75%. Now I'm making a huge percentage return every week. But then all you need to do is be wrong once. Be wrong once, be right once, be wrong once, and you've lost all of your account. That's not sustainable. That's not consistent. That's basically gambling. So 2%, regardless of your account size, 2% should be your max, because it gives you the room to be wrong. And we are wrong when we trade. Of course we are. In fact, a lot of the times we are more wrong than we are right. It's this ratio between reward and risk that balance that out for us. So we don't want to be risking any more than 2%. Again, you might meet the odd trader that might risk 5, 10%. That's an extremely high risk tolerance. And again, to me, you've got to have the data to back up that you are good enough, meaning your probability is high enough to warrant that level of risk. So the lowest, we don't really have a lowest. Of course, it has to be more than 0. Otherwise, don't trade. So anywhere up to 2%. Most people are going to fall around about the 1% mark. So this is where we're at then in terms of these numbers. Let's go back to $5,000 account, risking 1% per trade. We're comfortable with that risk, but we're not happy with the profits. What do we do? Okay. So in understanding how you feel about the risk, not just as a percentage of your account, but then by working out, based on my probability rate, how many times in a row could I realistically be losing, and am I comfortable with that amount? That helps you figure out where you're at on this risk spectrum, and therefore helps you to decide what other action you might do. If you're absolutely fine risking $50 per trade, and you're absolutely fine perhaps losing $350, maybe $400 before you're profitable, and offset that, great, do it. Maybe you then go, yeah, I'm fine risking $100. Doesn't bother me to lose $700 if I then make $750. Absolutely fine with that. Great, do that. But let's say you're a person that's just comfortable with the $50 risk, but you're not happy with the profitability. What are your choices? So you could increase the amount of trades that you place. So instead of placing 10 trades a week, you place 15. You could do that. And you've increased what you make at the end of the week, presuming everything else stays the same. Now, unfortunately, by increasing the amount of trades you place, you probably impact your probability a little bit, because there was probably a reason why you chose the original 10 trades in that week. Perhaps they were the best quality trades based on your understanding of the markets, based on the apps that you use, the technology that you use, the strategy that you follow. Those were the best ones. So now you place 15, that's 3 a day, if you're trading every day in the week. Maybe that extra trade each day is slightly less quality. So now instead of having a 30% probability, maybe you have a 27% probability, and now you start to lose money. 3% change in your probability has gone from being profitable to losing. Maybe you make 28% probability and losing. Maybe it's 29% probability and you're actually making less than what you were when you were placing 10 trades a week. So changing each of these variables is going to have an impact later down the line. So we need to figure out what we can do. Now, some people, coming back to our original set of criteria here, some people would be saying, I would never trade if I only had a 30% chance of being right. That's too low. I would probably be in that camp. We want to, ideally, I personally would say minimum of 40% probability. Because out of 10 trades, don't get me wrong, ideally, the weeks where you have a 60-70% probability rate, where the majority of your trades win, are obviously better weeks and more psychologically comfortable weeks than where your trades might lose more than they win, in terms of frequency. But you have to accept that regardless of your reward to risk ratio, your probability rate tells you how much pain you have to go through, how frequently you have to go through that pain. Are you okay with going through the pain of losing 70% of the time? Most people would say no. A lot of traders I meet that say yes find out in their application of their trading that actually it's no. So let's say we want to increase our probability and we say, okay, I want to be more selective on the trades that I place. I want them to have really, really high quality, and therefore I increase my probability rate to 50%. Maybe I can still keep my reward to risk ratio, but that actually means I can only place 5 trades a week instead of 10, because I'm picking the best of the best, right? I'm picking the really high quality trades. Half of them still lose. In this scenario, same account, same percentage, same reward to risk ratio, an increase in probability probably affected the trades. Overall, still a much better return. And this is the point, and this proves the point perfectly. In the prior example, if we go back here, 10 trades a week was making $25. In this example, half the amount of trades, but an increase in probability, is making $187.50. Huge difference. And you've halved the amount of trades that you place. So it's not those that trade more make more. That's not true. It's not even necessarily those that have higher probability make more, because let's do this the other way. Let's assume the same amount of trades, an increase of probability, but that reward to risk ratio, because you've increased the likelihood of winning, one way to increase the likelihood of winning is to decrease the amount price has to move in your favor for you to win. So instead of it being a 2.5% reward to risk ratio, maybe it's a 1.5%. Still much more profitable. Maybe it's become a 1.1 to 1. You place the same amount of trades, you've increased your probability, but your reward to risk ratio dipped, so actually you're making the same amount. So none of these variables by themselves equal profitability. It's how they all work together. And they can all work together in very different ways in order to give you a very different result at the end of the week, end of the month, end of the year, end of the day. Not one of them by themselves is going to make that much of a difference. It's how they all balance. And by changing one, do I change another? By increasing my probability, I don't by default increase my profitability. If by doing that, I decrease the amount of trades that I place and or I decrease the amount I make when I'm right. Now, what's good about this though is it does show a person that is right 30% of the time at a 2.5 to 1 reward to risk ratio is equally as profitable as a person that's right 50% of the time but with a 1.1 to 1 reward to risk ratio. So there's loads of different ways. You could put this to 90% and 0.5, try that. Yeah. 0.2, still profitable, more profitable, 0.1. Oh. 0.1 loses, let's do 0.11, 0.12. Try and get that to the same number it was before. Roughly. Okay, let's do that. Let's do 0.60. Okay. I'm just playing about with the numbers to see if we can get to the same profitability. But this is as close as we can get it without me having to be better at maths here. But here, you could argue the point, the person with a 90% probability rate, placing the same amount of trades with the same amount of risk, is making the exact same amount of money as somebody that had a 30% probability rate, because the reward to risk ratio was vastly different. So again, you can't say that person has, their trades are more likely to be right, therefore they make more money. Nor could you do it the other way and say this person has a 10% chance of being right, but each time they're right, they make 20 to 1. Or let's do 10 to 1. Let's do 9.5 to 1, see if we can get, there you go. Again, somebody who's right 10% of the time can make the same amount of money as somebody who's right 90% of the time, because it will depend on what they make when they're right and what they lose when they're wrong. In this case, same amount of trades, same risk, same account size. Probability changed, the reward changed, but profitability could still be the same. So what I'm trying to show here by putting in these different numbers and showing you these different things is kind of getting you guys to the point where you can look at this and you can say, okay, there are loads of different ways that I could be profitable. I can play with these numbers to whatever level within a huge range to still be successful. But where am I comfortable? Where am I comfortable? So let's say, let's assume here a 10 to 1, right? So you might play these numbers and you might say, oh, brilliant, I can be right 10% of the time. I've back tested it. I've demo traded it. I've proven that I can be right 10% of the time and still be profitable, because when I'm right, I make $10, and when I'm when I'm right, I make $500, and when I'm wrong, I lose 50. So I can lose 9 times in a row and then be right and still make money. Brilliant, I've proved that. But how do you feel being wrong 9 times out of 10? How do you feel being wrong 9 times in a row? Maybe sometimes 10, 11, 12 times in a row before you're right once or twice. Are you okay with that? Are you still going to be excited to get up and trade in the morning, or on your lunch break, or when you get home from work, if every trade you've placed that week up until Friday have lost and your account's been hit as a result? Does it affect you? Would affect most people. If it does affect you, don't do it. Because if it affects you, you're going to change your action. Most of the time, us human beings, we like to think that we're logical, but we make a lot of our decisions based on how we feel and based on subjective things that change based on whether we're hungry or not, tired or not, annoyed about something else in our life that has nothing to do with the markets, ego, pride. And those things can change on a day-to-day basis. So if it's affecting you even a little bit, find a different strategy. You might be a person that has a risk tolerance that's low. If you've got a risk tolerance that is low, maybe you risk less per trade. Maybe you risk less per trade, but you're also likely to be somebody that's not okay with being wrong regularly. Even if when you're wrong, you're losing a very small amount, it might still bother you. So maybe what you do is you say, I'm going to look for trades that have a much higher probability rate, and I'm okay if I make 1.5 to 1. When I lose $25. When I'm right, I make 37.5, and I'm okay with that. There will be others. So what that means, coming back to a chart, let's just show you this in real life. So coming back to a chart, let's do this. Let's say you buy at this line, your risk is here. So that's what you're risking from there to there. And your target is 1.5 to 1 away. So it's here, roughly. And you watch price do this. Price comes in, hits your entry, goes away, hits your target. Great, you've banked your money, you're now out of the trade, and price just continues to do this. And you had predicted the turn of the market, but you've made nowhere near the return that you could have. Are you comfortable with that? If you are, great. Or you might be saying, well, I'm not comfortable with it, but I'm much less comfortable to risk more money, or I'm much less comfortable to maybe risk that same amount, put my target up here and watch price do this. Get really close. Oh, so price does this, comes in, gets really, really close, and then falls away and I still lose. And I didn't bank any of that because it didn't hit my target. So my target was 10 to 1 away. If I'd have hit it, I'd have made a lot of money. But I have way less chance of it hitting it because I've got more time and more space for things to change between when I get into the trade and when I want to get out of it. You may say that's way more frustrating to me than having taken profit already here. And yeah, all right, I missed out on that. But at least I definitely made a profit. I'm much more likely to have made a profit. So again, none of them are right or wrong. It's how you feel. When I first started trading, I thought I was this person. I thought I was this person that would say, yeah, great, I want a really high reward to risk ratio. I'm okay if I'm wrong a bunch of times. I'm okay if it doesn't quite hit my target and loses, because it's only got to hit my target once or twice out of 10 and I'm at the bank, right? That's who I thought I was as a trader when I first started. Didn't take very long to realize that actually this green line for me has just kept coming continuously further and further down. I've settled now on about a 2 to 1, but this is me personally. Just because I do that doesn't make it right. It's what feels comfortable to me psychologically. If it's not comfortable to you psychologically, don't do that. Put it anywhere else, right? Anywhere else makes sense. For me, having a 2 to 1 reward to risk ratio and being right 45, 50% of the time, I'm happy with that. Really happy with that. I've learned over the years that where I've played with those numbers and I've tried to go, oh, if I'm right 90% of the time and I make 10 to 1 every time, I'm laughing. But reality doesn't work that way, unfortunately. The higher the probability rate, the lower the reward to risk ratio. The higher the probability rate, meaning the more selective you are about the trades you place, the less trades you place, which also has an impact. The lower you are on your probability rate, the more trades you place, the more trades you lose, but perhaps the more you make when you're right, depending on where you put your target. Loads of different factors that all impact each other. Again, we need to figure out where we're comfortable. What pains you more? Does it pain you more to see loss after loss after loss after loss after loss and then a big win, but you've had to go through all those losses and that hurts? Or does it hurt more? Does it pain you more to see little profit, little loss, little profit, little loss, little profit, and see that all of those profits perhaps, or one or two of those profits, could have hit the moon and you weren't a part of it? What hurts you more? And you'll figure out, your answer to that question will help you figure out where your reward to risk ratio should be. Where should you be placing your targets? Equally, you might be saying, I don't want to be placing loads and loads and loads and loads of trades. I actually only want to place a couple of good quality trades in a week. So instead of 10 trades a week, maybe it's 2. And you look every day, and more days than not, you spend time looking and you disqualify most of your trades and you don't do it. You only end up placing 2 trades a week, but you have a high chance that they're profitable for you. And you'd rather do that than look every day and place 10 trades every day and most of them lose. You're still profitable by the end of the week, but you've had to take many losses in order to see that profit. None of them are right or wrong. It's just how that is. So let's come back to the amount of trades we place in this example, just to show you what I mean here. So let's say we are risking 1% of our account, same account size. Again, change the numbers for your own, wherever you're at, whatever your account size is. You might have 5 million in your account and be happy risking 2%. You might have $1 in your account and want to risk 0.5%, which is hard to do because you can't risk 0.5 cent. But you get my point. You could be anywhere on whatever spectrum. So let's just assume these. Let's say that by placing 10 trades a week at a reward to risk ratio of 2.5 to 1, 10 trades a week, you put your target at 2.5 to 1 away, and you reach that 30% of the time. By the way, could you learn new strategies, implement new techniques to increase that number without necessarily affecting the reward to risk ratio? Yep, you could do that too. Or you might find it easier to simply change your reward to risk ratio and increase your probability and make a little bit more. Or you might try and do both. Depends on your time availability and learning capacity and what you want to do. So many ways that you can change this ultimate number. But on this case, let's now focus on the trades themselves. So let's say you say, okay, instead of placing 10 trades a week, I'm only going to place 2 trades a week, and my profitability is now 50% instead of 30%. Same reward to risk ratio. You've placed a lot less trades, but you've made 3 times more money. Now, what if in placing a lot less trades, your probability went up a little bit? So it went from 30 to, let's say, 35. You increased your probability, you place less trades. So you could argue each trade is worth more, but you're still making less money. You're making more money per trade by far. Much more efficient way of trading in terms of the value per trade, but you're still not making as much. So again, you balance that. You might be somebody that goes, I want to place 100 trades a week. And maybe that means that you have, 10% probability though, and you actually end up losing a bunch of money because you're placing a bunch of trades you shouldn't be placing that don't have quality or don't have the right checkboxes being checked in order for you to place them. So again, there's going to be a range here. Changing the amount of trades that you place invariably will change your probability. Changing your reward to risk ratio will also change your probability. Changing the amount of times that you want to be right out of 10. Maybe it's, let's go back to that. Changing the amount of times you want to be right out of 10, that's going to require learning, practice, backtesting. All of these do that, by the way. You're still going to have to learn stuff. You're still going to have to practice it. You're still going to have to backtest it. But it might be that it's easier for you to say, do you know what? I'll decrease my reward to risk ratio to 2 to 1. That increases my probability to 40%. And actually, all I've done to increase my probability, I haven't changed my strategy at all. My checkboxes remain the same. I've just lowered my reward to risk ratio a little bit. So I take less profits every time I'm right, but therefore I take more profits. Maybe it doesn't have that greater effect. Maybe it goes from 30 to 35 and you get the exact same profitability, but at least you're right a little bit more often. You might make less when you're right. There's always going to be a sacrifice of one to get a gain on the other. But many different combinations can result in profitability, making money, but in all different ways. So I feel like I've now given you guys, what's the time? Oh, kind of coming to the end anyway. I've got about 5 minutes left. So hopefully what this has done is this has given you proof, I guess, that you can be making money regardless of what you're doing, in the sense of two people could be trading in vastly different ways, placing loads of trades or placing hardly any, and be making the same amount of money. Taking a bunch of risk as a percentage of their account versus taking a very low percentage risk of their account and still be making the same amount of money. Somebody could be putting their targets really far away and be taking huge chunks out of the markets very infrequently and make just as much money as somebody that's risking this to make this and does that regularly and is right more often than they're not, and make the same amount of money. And anywhere in between those spectrums can also be a profitable way of doing things. You've got to find the way that makes most sense to you. Now, rather than go and backtest every single combination, every single set of criteria that could possibly happen. My personal take on this is start first with how comfortable am I with this loss, how many times before it bugs me. If I lose $50 a couple of times and then I'm right, am I okay with that? If I have to lose $50 5, 6, 7, 8 times before I'm right, am I okay with that? Whatever that number is, by the way, it's going to be a percentage of your account, right? Start with that. How do I feel about this? If I lost it once, if I lost it twice, if I lost it 3 times. Figure out how comfortable you are with that. That will then give you an idea of what that probability rate needs to be. And therefore you might say, okay, as much as I'd love to be taking 5-to-1s, but actually at the moment that's only happening 20% of the time, or say 15%. 15%, okay. As much as I'd love to make 5-to-1s, that's only happening 18% of the time. So 82% of the time I'm losing and I hate it. You might go, do you know what? I'll drop that to 3. That might become 25% or 28%, 27%. I make the same amount of money, but it hurts me less, right? So you can, by understanding how you feel about the loss, which is very subjective, how many times in a row before it affects you, helps you understand what your probability rate needs to be in order for you to be a comfortable, consistent trader. And then you can start to play with what happens then if I change the amount of trades that I place. What does that do to my probability rate? Keeping my reward to risk the same, what does that do? Or changing where my reward to risk ratio is, keeping the trades the same, what does that do to my probability rate? And therefore, how much money do I make? So understand how you feel about risk and then play with the other variables to find the thing that works for you and to find the thing that works for you on a consistent basis. No point, back testing something for the last week and going, oh, wow, if I'd have done this for the last week, I'd have made 100% in the week. Brilliant. That's not enough data, right? That doesn't really prove a point. It could have been a lucky week. Equally, you could back test something that shows you that for the last week you would have lost money. That doesn't mean it's an overall losing strategy. It just means for the last week, it just happened to go that way. So collect your data. Personally, I would say at least 100 trades, but 30 really is the absolute minimum. Collect as many trades as you can, either by trading this in a simulated environment, demoing it first, by testing your theory of saying, again, we'll go back to our initial parameters that we were working with there. Maybe this is you right now, and you want to increase that number, but you're uncomfortable already with the amount of times you have to lose. Maybe you said, you know what, I could take that loss. I could take it 3 times in a row before I have to be right. So that's a 25% probability rate that you'd have to have. So actually, maybe you're okay with that. Maybe you say, I could take it twice in a row and then I need to be right. So your probability rate has to be a minimum of 33%. In order for that to happen, you're probably going to have to change either your reward to risk ratio or the amount of trades that you place. So maybe you say, do you know what? I'll keep my ratio where it is and I'll just pick higher quality trades. In theory, this is what that makes for me. Let me go and test that. Test it, back test it ideally, collect at least 30 trades to prove your point. That doesn't mean go and find the trades that prove your point and keep them. I mean, go and collect the trades as if you would have placed them on as if it was today and see how many lost and how many won and what your numbers were. You could do it in a simulated environment from now into the future. It's just going to take longer. Backtest it, prove the point. If the point is not proven, maybe you say, well, I was more strict on the criteria for my trades, but I still didn't hit a 33% probability. It only went to 31%. Maybe I'd do something different. Maybe I do move my reward to risk ratio down and I increase my probability by doing that. What happens there? Whatever. Figure out how you feel about risk, and then play with the other variables so that you can end up with a conclusion that, one, that you've proven, but two, is comfortable for you. So you do it on a regular basis and you make money consistently, rather than make money one week, lose money the next week, not really know why, not really know what's happening. You watch a video and somebody says, I risk 2% per trade, which means when I'm right, I make loads, and you go, oh, I'll do that. Or somebody says, I have a 90% probability rate, and you say, oh, that'd be brilliant, because I seem to have a 90% losing rate, so let me do what they do. But actually, maybe they've got a 90% probability rate, but they're risking one to make, I don't know, 0.2, 0.15. They're not actually making very much money. Or perhaps they're only placing one trade a week and you want to be trading 10 times a week, whatever. So don't just take what somebody says about one of these things and implement it into your trading. Figure out what it is that makes you uncomfortable, what it is you're unhappy with, and therefore what you can do to change it, and figure that out by testing. Okay, I feel like I've gone on a lot about that. So let me just round off and show you where you can go for different questions. So if you go to tradewithufos.com/Becky, you'll have different platforms at the top and apps, resources, coaching that you can book there if you'd like. You can log in here for free and ask a question, or you might find that the answer to your question is already there. Or you can email me, which is becky@tradictive.com. So you can email me on that as well. So today being Saturday, I will wish you guys a great rest of your weekend, or the remainder of your weekend. Have a good one. I'll see you on Monday for our next market commentary session. Any questions, please let me know. I'm here to help. Hopefully this makes sense. Hopefully I didn't labour the point too much, but for those that are newer or for those that have been struggling, hopefully this helps to highlight some things that you might not have thought about before or not realised before. Hopefully it was helpful information. Of course, if it wasn't, you're probably not watching the end of this video anyway. So hopefully if you were with me until the end, that was helpful. Okay, all right, take care, guys. I'll see you soon, and let me know if you need anything.